Welcome, everyone. This is Marc, Wealth Advisor and Chief Investment Officer with CAM Investor Solutions. Thanks for joining today. We have a couple of special guests from the West Coast out in Sausalito, California today joining us with Sam and Sarah Adams. They are the co-founders of Vert Asset Management, which also manages the Vert Global Sustainability Real Estate Fund. So welcome, Sam and Sarah.
Thanks, Marc.
Thanks for having us.
Absolutely. So Sam is the Chief Executive Officer and Sarah is the Chief Sustainability Officer for the firm. There's a lot to talk about today, and I know our audience will really enjoy this because a lot of what is happening with the pandemic, I think, has been accelerating a lot of what you're seeing and hearing and involved with currently. But first, there's this topic of, we've heard ESG, sustainability, SRI, investing, all these different buzzwords over the last decade and beyond. So before we jump into some of the questions I had for the both of you, I wanted to just maybe have you share what that means for our audience. Because again, I think there's a lot of confusion, and I think it'd be helpful for you to run through that ESG sustainability discussion and lay a foundation for today's discussion.
Sure. Yeah. As the interest in sustainable investing has grown and even exploded in the last couple of years, it seems like it's getting more confusing rather than less confusing on the terminology. Everyone uses these words interchangeably, so it's difficult to get a grasp on it. The way we like to describe it is that there's three main forms of sustainable investing. Now, there's probably 1,000 different ways to do it, but there's three main categories. And we put those three in between the things, bookends that most people are familiar with, which is conventional investing, where you're trying to maximize financial return, and philanthropy, where you're trying to maximize an environmental or a social outcome, right? And so people are very familiar with, make as much money as you can here and then give away some here to solve problems. Now, more and more people are becoming less enamored with that binary approach to their finances. And so they've developed alternatives, which we call sustainable investing. The first and most, historical way of doing that was SRI, or social responsible investing. That really came from religious investors or ethical investors who said, I want to invest for total return or maximize my financial goals, but I have some no-go areas. I'm not going to invest in companies that are bad actors or doing things that I don't agree with, or creating products and services that I have an objection to. And so there was a balancing there between, pursuing returns and their own personal values. And that has been around for several hundred years, at least. The next entrant was impact investing. And this was really, it's closer to philanthropy in the sense that it was like a bunch of wealthy people figured out that some social or environmental problems aren't being solved rapidly enough through philanthropy. And so they wanted to try a for-profit model to, say, fix poverty in Africa or hunger or something like that. And so they started using for-profit business models to solve those problems. That's impact investing. And usually that's a private equity or a private debt instrument or a private placement or a single project. The latest entrant is ESG, environmental, social, and governance investing. And that really comes from big institutional investors who started looking beyond company reports, beyond things like the PE ratio or the earnings, and said, what else is going to impact this company? Are there certain things about their use of natural resources, or are they creating pollution, or is there risk in their supply chain? These things were called non-financial information because they weren't being reported by the companies. But that attempt to get a better grasp on risk and return was called ESG investing. Now, a lot of the things that ESG looks at, like pollution and climate change and treatment of people, is what sustainable investors care about. So it's become a way for sustainable investors to invest according to the things that they care about. So really, there's those three categories: ESG, which is more about pursuing economic value; SRI, which is about balancing your pursuit of economic value and your individual values; and then impact investing is really about solving particular problems through the use of catalytic capital.
Okay. No, that's very helpful, because I think there's a lot of confusion, as we all would agree on. And so more understanding and education there is important. And kind of jumping into Vert, All three of us have been in the industry in finance or something related to finance for 20 plus years. In full disclosure for our audience, Sam, you and I worked together from across the pond. You were running Europe and I was in the States for Dimensional Fund Advisors. So then and now we still work and talk and hang out with a lot of advisors in the community. So given that you have worked with thousands of those individuals and institutional folks over the years, but also now even dozens still as clients of Vert, maybe just share a little bit more about what Vert provides to their clients and kind of how that got started.
Yeah, so Vert's mission is to make sustainable investing easier so that more investors will move more of their money into ESG investing, and then capitalism will start to price these things that we care about and will evolve to a more sustainable way of operating our economy. And so making it easier for financial advisors and individual investors to invest is the key. And the first pillar in that is providing investments that work for investors to solve both their investment goals and their sustainability goals. And as you mentioned, we have the Vert Global Sustainable Real Estate Fund. That's our first investment product. And it's designed to help an advisor and investor who has an allocation to real estate to invest in that category in a sustainable way.
Okay, good. And you mentioned, I heard a couple terms there, obviously environmentalist and capitalist a few minutes ago. There's a phrase I think you've used, I am both an environmentalist and a capitalist. Kind of maybe share what that means for our audience, because I like that phrase and I want to kind of hear I've heard you say what that means, but I want to kind of hear you say it again.
Well, you know, it used to mean that you were at odds with each other, right? And it was kind of, you know, the way we used to look at finances was the capitalist would invest for total return, and then the environmentalist would give some money to some charities, right? And the advent of sustainable investing has given us an opportunity to blend those. And the start of Vert was really our desire to start using capitalism as a way to start solving these environmental and these challenges for social issues as well. And that's what ESG investing is all about. So it's exciting to me to be able to blend that environmental side of my personality with the capitalist side of my personality.
Okay, no, thank you. I mean, I found that hearing you discuss that previously, and I've always found interest to me is how you position that and how you kind of bring the two together. So thank you.
A big part of how we bring those two together is our engagement work that Sarah leads on as the Chief Sustainability Officer.
Well, I mean, I would say when we started the business, we felt that there was a hole in the market where you had very investment focused companies only, and then you had a big chasm between what a sustainability or SRI investor and that business looked like. So we were trying to position ourselves in the middle, and part of that is engagement. So we're a certified B Corp. We engage with other investors to push companies to do ESG related things like report on greenhouse gas emissions. And then we engage with the company ourselves as an investor with a fund with the message that we're an ESG investor and these things are important to us as an investor, and we're based in the US. Because a lot of times their sustainability teams will say, oh gosh, we've never received a call from a US investor concerned about these things. But together, that's a value add to our investment proposition.
That's great. And it sounds like with that, you've been able to evolve since day one with Vert. What kind of trends are you seeing out there in the industry today for ESG? And I guess since while we're on the topic of real estate, even across REITs, I mean, what are some of the trends you're seeing evolve? And I'm sure that I hear that a lot of things are happening quickly, so I'm curious to hear your thoughts.
Well, I think on the investor side, right, ESG investing and sustainable investing has gone from a niche, pursued by just a few people to being embraced by large institutions, by 401k plans, by individual investors, by financial advisors. It's really exploded. And as a result of that, companies are responding. More and more public companies are making stronger and stronger commitments to sustainability, and they're reporting more on those efforts. Things like their greenhouse gas emissions, the way they work with their supply chain. All kinds of data has now become available. So it's with more of that data, better quality data available, and more demand from investors, we can do our jobs better of investing on a sustainable basis in companies.
Yeah, just to add to that, it's important that the investor community receives this data from companies, non-financial data, through the resources that they use, like a Bloomberg terminal. And that has now started to happen and has been happening for a few years, but is more formalized now. With CDP, Carbon Disclosure Project, and also SASB, Sustainability Accounting Standards Board. Those two efforts have really moved the quality of non-financial data to a data space that investors can use.
So it sounds like that's the data aspect has evolved pretty quickly through use of technology. Are there anything that maybe hasn't gone as fast or as well as you or others in this ESG sustainability space would have liked? I mean, I'm sure there's a lot to say there, but anything that sticks out?
Yeah, it's what we talked about before. As Sarah said, the frameworks and the standards around the data are starting to make those more robust and standardized, but the terminology is exploding in the other direction, right? So now we hear people talking about using the word ESG to talk about impact investing or to talk about SRI. And so that terminology and the jargon has made things worse, actually, and more confusing.
Right. So kind of saying with that, because again, I think a lot of us are guilty in our industry of using jargon, right, for anything, not just ESG. And a lot of consumers, investors that try to read, especially in today's social media world where it's just nonstop coming at us. If you had to talk to our audience today that maybe has experience in this space, has interest in this space, beyond maybe some of the traditional views on it, what do you think some of the primary reasons that investors might want to invest in ESG or sustainability or something of the like?
Well, we have a list of top 10. There's probably, hundreds of personal motivations. But the one that I think is probably the most broad based, that probably covers more people is, and let's keep in mind the numbers here, when they do surveys and they ask people if they're interested in sustainable investing, it's over 75% of people say yes to that question. So it's really a lot of people are interested in it now. And we like to use to talk about the motivation that people have around being part of the solution rather than being part of the problem. We've heard for decades now that we drive too much, we fly too much, we eat too much red meat, we use too much single-use plastic. We all know that we're the problem, right? And we think that people, if they can be part of the solution, if it's not too disruptive in their lives to start being part of the solution, they'll do it, right? They'll recycle, or they'll start taking a bag to the Whole Foods or whatever, right? To just be on the solutions team rather than the problem team. And a great thing about sustainable investing is that it's now easier and more cost effective and better performance than ever before to do it. So now it's not disruptive to someone to start doing sustainable investing. Like before, it was really hard. It was quite disruptive. Now it's not. And so as more and more things become easier to do, more sustainable ways of being part of the solution are available, more people will adopt them.
That's a really good. Go ahead, Sarah. Sorry.
Oh, it's just filling that in is that there's more products available. So that's why it's easier to do. Whereas before it was really a hurdle. The financial advisor, an onus put on the financial advisor to go, create a separately managed account to fulfill maybe one client's need, where it's more clients are asking for that and the product providers have that available.
Yeah, that's a good point, because I think when I started my career, some of those expensive products, it was limited, it impacted, return goals. And that's been a hot topic even, I think, in the last few weeks of discussion, right, with some of the regulation folks trying to say you can't invest a certain way because it has a negative impact on the return, which I think, like you just said, that has evolved. And in some cases, the risk return trade-off might be just as good, if not better, you know, and so maybe speak for a couple minutes about that argument, because that seems to be in the media of late quite a bit.
Yeah, you know, people, now that there's a lot of data that ESG doesn't underperform, like to suggest that that was a myth of underperformance, but there's actually some basis for truth in that, and that's because, like you said, Mark, 5-10 years ago, the funds that were available were more SRI funds. They were actively managed. They were expensive. They weren't well diversified. A lot of them were like that. And those types of strategies tend to underperform, not because they're SRI, but if you have an expensive fund with lots of turnover and it's undiversified, the performance is probably going to suffer. Now we have these ESG-based indices, and we have well-diversified, low-cost portfolios that capture the asset class and are structured to deliver the returns. So there's less underperformance. So that myth of underperformance has some basis in fact, but now the products are better and you don't have to underperform.
Yeah, that's good to hear. And I heard you both use the term bad actors, which I love that term in a lot of different things, but maybe talk to me about what you both mean and when you use that in reference to what you all do.
You mean like a Hollywood bad actor? Like we gotta
Like, for you. Let's talk about the sustainability ESG world for now. We'll get into maybe if we have time at the end, the LA Hollywood world.
Well, I mean, in our estimation, ESG has evolved to weed out those bad actors. So ESG came from things like Exxon Valdez in the 1980s, the large oil spill, Bhopal in India, South Africa divestment. It comes from trying to understand ways in which companies are being bad actors. Do they have a bad board composition or a pay ratio from executives to employees? What kind of metrics can the market look at to understand who's behaving bad behind the scenes? Because companies are kind of these mini families, if you will. And what are the metrics that we can look at to evaluate how they're doing from the marketplace? And when you're a publicly traded company, these things can be required by regulation and through CDP, GRI, SASB. This is the work that's helped to pull out some of those E, S, and G criteria.
Which is all about identifying the risk in those bad actors, right? Those events Sarah just mentioned had catastrophic consequences for the stock price of those companies. And so big pension funds, big institutional investors were looking for this data so that they could potentially identify and eliminate those companies from their portfolios. And so, as Sarah said, the ESG movement is weeding these actors, these bad actors out, because what companies are starting to realize is that those are risks to themselves of if they're flouting environmental laws or if they're taking advantage of their people. There's lawsuits on the horizon, or environmental fines, or things that are going to happen that's going to be really bad for their company. And so we think there's less and less bad actors out there.
I mean, for the economic value of the company.
Yeah.
Period.
And so now we like to think of the bad actors as a shrinking universe, and there's a couple in several industries that you can point to that are doing the following thing, which we think is really perverse. They know that their business model is going away. Some of the old dirty energy companies are a good example of that, like coal and some of the oil and gas companies. And rather than fight the normal fight, the good fight of capitalism, you know, the dominant players who have earned market share because they have the better products and services, struggling against the disruptive innovators who are coming up with new ways of doing things and letting that kind of marketplace battle out. Some of these older companies are protecting their status quo, you know, looking after their vested interest by fighting unfairly. Right? They're buying politicians, they're lobbying for regulation changes or rollbacks that will allow them to continue their less good way of doing business at the expense of the newer, better ways of doing things. And that's what we consider a bad actor now. Taking your profits and trying to defend your old bad way of doing things rather than adjusting your business model to the newer, better ways of doing things.
Right. No, thank you for that, because I think that's always a good transition into kind of where we're at today with, being in a pandemic. I think we've all had a chance to think about a lot of things, being at home quite a bit or wherever we're at. But given today's environment, I feel like a lot of things have accelerated. Look at technology, for example, things that maybe we're going to take 10 years for us to achieve, or companies and we all alike have been forced to accelerate that in a matter of months, right? So, and within the ESG sustainability world, are you seeing some similar trends happen, whether it's regards to real estate or anything else, as far as that acceleration of things taking place?
Well, so during this time, we do reach out to every company in our fund each year on a planned engagement. This year it will be net zero, but we postponed that given our current pandemic situation, and wanted to understand a handful of companies across a handful of sectors within real estate, what they were doing around COVID and how they were changing their policies or supporting different stakeholders that they interact with. So real estate primarily interacts with tenants, employees, and their communities in this frame.
Mm-hmm.
And so one of those things was, like, speaking of rapid change, was moving online, all work from home policies. So of course, many industries don't really support work from home, but this current situation made everyone work from home across the globe for the most part. We do hold companies across the globe, even a company in Hong Kong, they were working from home, and they admitted that they were not set up to work from home beforehand, and they had to get that IT support, the computers available, and additional mental support for their employees who were now dealing with the one issue is in Hong Kong, the way people live primarily is in smaller apartments. So being homebound for hours on end
with kids,
they did close their schools as well for some time. That is a mental support that the company was giving that hadn't been given before.
Yeah, I mean, working from home in a single family home, like a 2,000 square foot home or something, I think is vastly different than working from an 800 square foot apartment in a high rise, right?
Yeah, no, I think I can empathize with that. Having our daughter was crawling on my shoulders on several of these calls over the last 5-6 months. So she's gotten to know quite a few people during this time frame and understand what a computer is and a cell phone. So that's good or bad, but we'll find out in a few years, I guess.
But as Sarah was saying, that a lot of that focus of the companies on their tenants, right, which are their customers, on their employees, and on their communities, is really a focus on people. And this is a health crisis, right? So it's a human crisis, and the response has been appropriately human. And this feeds into a larger trend that was slowly gaining traction, which was the S in ESG, the social part, the people part, was always kind of the small letter in that triumvirate, right? It was, there's less robust data on it, and people paid less attention to it. And it was growing in importance, particularly in buildings, as more research came out that healthier buildings with better air quality and better natural light and things had better worker productivity, right? And now, of course, with with COVID, the focus is all on that, and so S has risen in importance within ESG. That was a trend that was happening before. This has definitely accelerated that.
For sure.
Absolutely. Given a lot of your audience of advisors who work with you and, to this day and in the past, there's a lot of, I think, the last 12 months and beyond, there's been a lot of discussion on this topic. There's been new strategies launched as well. What kind of questions are your advisors asking you about ESG sustainability in terms of trying to understand the differences and what's appropriate for them and their clients?
Well, the questions used to be, is it possible to do, or should I do it? And those have largely gone away, and everyone's saying, okay, I got to do this, or I get to do this. Now they're asking, how do I do it? And the focus of that is around how to build portfolios that, achieve the investor's goals of risk and return. But more of it is how to talk about it, which is really a question around how to integrate ESG investing into their current investment philosophy and make that consistent. And so, and this is an important point. ESG isn't fundamentally different than regular investing. It's the same exact process. You do a risk analysis and asset allocation. You set all those things, and then at the last minute, you use a sustainable solution rather than a conventional solution. So it's not that big a difference, but there's a whole new way of talking about things and understanding that confusing lexicon of jargon. And so that's one of the main questions we get from advisors, is how to integrate it and talk about it.
Are your advisors asking you for other innovative strategies, perhaps other ways to invest in this way beyond just, let's say, real estate, for example, that you all manage?
Yeah, 5 years ago, I think when we started the company, there were lots of questions about lots of different asset classes and how we could get more products to them. Now there's more products available, but there's still questions about several different categories within bonds, like municipal bonds and green bonds and high yield bonds. People want specific solutions that are sustainable in those categories. There's interest in infrastructure, and there's a couple of asset classes within equities that aren't fully addressed now, like the small caps, and some of the emerging markets don't have a lot of products available yet. So,
okay. No, it's helpful because I'm always curious to hear what people are, like you are talking about within real estate. Since I know that's a lot of right now what you've been doing the last few years. Are some of these real estate entities increasing their focus in this space? Again, if they weren't before, maybe the pandemic has caused them to accelerate again some of that. Maybe talk about that, what's going on in the real estate world in particular.
Well, so we do invest primarily in the most sustainable real estate companies that we've determined by our key performance indicators and qualification rubric. So we wouldn't say that we have laggards per se. But in the first year, there were a handful of companies that we spoke to that didn't report into this group called GRES, the Global Real Estate Sustainability Benchmark. And through a couple of conversations with those companies, one namely in the data center space, which is a specialized REIT, it's a very small space, so they don't have many competitors, is kind of the point. That after a conversation, the following year, they did start reporting to GRES. So there is some change for those teams who are recognizing that they either need to catch up or that they have an ability to lead as a company. So there's really a race to the top rather than, we're going to wait and see and stick to their guns in terms of REITs that we're seeing.
Yeah. If you're a cyclist and you follow, say, the Tour de France or something, the analogy we like to use on that is there's sometimes a couple of cyclists that break away from the peloton, the big group, and they head out ahead of everyone. And then there becomes a breakaway group that kind of chases them down. So there's a couple of riders way out in front, and then maybe 20 or 30 riders behind them trying to chase them down. And then the peloton eventually eats them up by the end of the race, if you've ever seen those. And we think part of our job is to identify the ones that are breaking away and heading out and being the leaders, but then help the peloton catch up, right? We want all of the companies to start being better at this. And as Sarah was saying, more and more of those laggards in the peloton are realizing that to stay in the race, they'll have to pick up their pace. And we've seen a lot of that. A lot more reporting, a lot more ESG initiatives, a lot of progress in that front.
Interesting. That's a good analogy. I like that because I think you're right. People are going to have to be forced to keep up in a lot of this area of not just ESG, but I think investing in general. So that's good to hear. Kind of looking forward again, none of us are health experts. With COVID-19, we can't forecast what's going on, wouldn't even try to. But for individual investors and financial advisors who we all talk to, what should they keep in mind going forward with respect to ESG? What should they be looking for? What kind of questions could they be asking their advisor or evaluating when it comes to this area for investing?
Well, I'll just say something
I know
about
there's a top 10 and beyond list, but if you had to narrow it down to a couple.
I will say something about the COVID crisis that one of our financial advisors shared with us. She reminded us that after 9/11, people were saying that no one was going to go into a tall building anymore, right? But a few months later, we were back to working in tall buildings, and now people are saying we're never going to go back into offices anymore. We're not going to open schools anymore, but we will get back to a normal way of operating. It will look different. And I think that this is a great opportunity for lots of companies to reorient their businesses to be better prepared for the future. That trend of having healthier buildings with better indoor air quality, now it was a nice to have, now it's a must have. And so a lot of our spaces, a lot of our the buildings that we go to school in, that we work in, that we live in, can be better for people and do less damage to the environment at the same time. And so the questions that investors are going to want to ask is, how do we invest in those, right? How do we avoid the risky ones? How do we avoid tilt our portfolios to the ones that are being more sustainable and promoting health and well-being?
That's good. And to that comment around tilting portfolios in that direction, question for you both is there a perfect ESG investment strategy in your opinion?
Well, there's ours.
Good. There you go. You answered it.
No, there isn't. And just like there's no such thing as a sustainable company, purely sustainable company, there's no such thing as a purely sustainable portfolio. So this really is a question of degree. You wouldn't want a pure microcap portfolio or a deep value portfolio. That's the only thing you invest in. You wouldn't want, just the most sustainable company you can find. So it's a question of tilting to the companies that are more sustainable and away from the ones that are less sustainable. And that does two things. One, it sets your portfolio up for the future a bit better, but it also encourages the laggards in the peloton. It's like, right now, 25% of all dollars invested on a professional basis in the US are invested on some kind of sustainability criteria. Some of those companies, as that number grows, more and more of those companies are not going to forgo that part of the investor base. And they're going to say, I have to get my game together to attract that capital.
Interesting. That's good to hear. And then just the last question is, with so many things going on in the world going forward, if you had to tell investors, financial advisors, anything as far as opportunities, where is the opportunity now for that audience for ESG, for this space right now?
Well, there's a couple of opportunities. The one that is really mind-blowing when you look into it is all the technology that's making sustainability so much easier. From a personal level, you could take your old thermostat and replace it with one of the newfangled Wi-Fi connected one like the Google Nest, and it'll cost you a couple $100, but you'll be saving thousands of dollars on your heating bill over the next year. Imagine those technologies at scale for big buildings, across portfolios of big buildings. We did a case study on the Empire State Building that they did an energy retrofit in 2010 that reduced their energy use by 38%. And they started saving $11 million a year on their utility bill. So there's just all kinds of new technologies, whether it's renewable energy or energy efficiency technologies or some of those safety and health technologies like indoor air quality that are coming on that just make it profitable and easy for companies to do this. And, you know, we would rather be invested in those companies that are embracing that than the companies that are doubling down on the old ways and are not investing in for the future of that. So that's one area where we're very hopeful because these technologies are coming on quickly.
Yeah, I mean, just on that, you know, that's one reason why we started the fund in real estate. Not only was it a missing asset allocation for financial advisors who use a model portfolio, but it was tangible. So to get these ideas across of sustainability and how they pay out on the bottom line, a building is something you can go into, you can see, and then yourself as a homeowner, even you could look at your energy bill after you changed your lights from incandescent to LED.
Yeah,
it's something you can live in, whereas some of these other things are more hypothetical or abstract to get your head around.
Yeah, well, I think that the tangible aspect, I think, is key, right? Not just in day-to-day, what we touch and feel, but the real estate aspect. Keep advisors, I feel like a way to do it in a way they can see with more transparency, which we all like to have, right, as far as what we're doing day-to-day. So I think that's significant. So Sarah and Sam Adams, thank you so much for your time today. Vert Asset Management, appreciate this, and we'll obviously want to have you back soon as we progress in the near term through the pandemic and beyond, and watch you guys continue to grow as you are. So thanks again for the time, and we'll talk to you all soon.
Thanks, Mark.
Thank you.